As expected, the Bank of Canada held rates steady at 2.75%. Joining me now to discuss the decision is Lauren Belli at TD Asset Management. And Lauren, there wasn't a lot of uncertainty coming into this meeting on whether they'll cut or not. What was it that led them to hold?
So as you mentioned, the interest rate right now is 2.75%, which is the midpoint of the Bank of Canada's neutral range. What that means is they don't think the policy rate is either stimulating the economy or restricting the economy. I think what held them back and kept them on hold was inflation. More recently, we've seen core inflation metrics rise. The most recent report we had for April, we saw core inflation rise to 3.1%. This is the first time in over a year that metric's been over 3%. So that's giving them a bit of pause. On the other hand, though, we are seeing some signs of modest growth slowing, as well as unemployment rising. But these are not at levels that are recessionary. And just to quote the Bank of Canada from their statement, they said it's actually the economy is softer, but not sharply weaker. So that just kind of gives an indication of where we stand on the economy. While we are seeing these signs of slowing, inflation is higher. When we balance these two together with the Bank of Canada being at their neutral rate, it does give them some flexibility. And I would expect that the bank is more reactive than proactive with their policy this cycle.
Okay, so let's talk about the financial markets and the reaction. Recently, we've seen a move higher in bond yields. What's driving the steepening of the yield curve?
Yeah, so what we've seen is long end rates rise more than front end rates. And this is being more pronounced in the US, with long end rates rising by about a quarter to 0.5%, while front end rates have actually been relatively anchored. What's driving this is what we call term premium. What that means is people want to be compensated for holding longer term bonds. So they want more money in their pocket if they're taking on that longer term risk. Typically, what you see in an environment where growth is downgraded, which is the environment that we're in right now, this term premium and rates fall. But because of the elevated geopolitical uncertainty, rising deficits in the US, we've actually seen the opposite thing happen. It's risen, which have led long yields to rise. While this is more pronounced in the US, we are seeing it impact global markets, including Canada, where we've seen long end rates rise by about 0.15% more than front end rates.
Okay, now you mentioned earlier that Canada's overnight rate sits at the midpoint of the Bank of Canada's neutral range. What do you expect from the Bank of Canada for the rest of the year?
Right now, the market's pricing about 1.5 cuts for the rest of the year. I think that's relatively reasonable. That would put the overnight rate at the lower end of what we call neutral. And the Bank of Canada themselves actually said in their statement that the balance of people on the governing panel are to cutting rates this year if we see the economy stall. So I think that's a good indication that the market's got the story right so far. To be clear, though, the base case is not for a recession. There's a lot of uncertainty, so I think how the Bank of Canada actually moves policy also has some uncertainty around it. I'd highlight 3 areas of uncertainty as they relate to growth and inflation. The first is trade policy. That doesn't surprise anyone. But we did just see today steel and aluminum tariffs increase from 25% to 50%, which does disproportionately impact the Canadian economy. The second area is the impact of these tariffs on businesses and consumers. We don't yet know exactly how they will react. We've seen some pull forward of growth. We've seen consumption slow, but ultimately, the longer these policies are in place, how people react is very uncertain. The third area is actually a positive one. We have a new federal government here in Canada, and that marks a regime shift, which actually could increase the opportunity for output in the economy, could increase productivity if policies are implemented well. So I think in this environment, the best thing to do is think about a range of possibilities as opposed to one finite path, as much as we all love to stick ourselves in that. So I think in this case, that would be the Bank of Canada either cutting rates modestly or staying on hold for a little bit longer.
Okay, so given this environment, and you talked a lot about the uncertainty of tariffs, how do you expect the Canadian dollar to perform going forward?
So what we've seen so far this year has been, or more recently, a strengthening of the Canadian dollar. We've seen the kind of worst case scenario for tariffs seems to be off the table. We've seen the US dollar weaken versus global currencies since the start of the year, and that's been a tailwind for the Canadian dollar. So it's around 72, 73 cents. I think as we look going forward, the marginal dollar invested will probably be outside of the US. Now, I'm talking incremental, but that does create a tailwind for global currencies and the Canadian dollar. So I think going forward, a reasonable path would be for the Canadian dollar to strengthen. There might be some bumps along the way, but I think the trajectory would be stronger.
And finally, what's notable that you'll be watching as the Bank of Canada considers its next move?
The first thing is going to be inflation. So we'll get 2 inflation reports between now and their next meeting on July the 30th. We'll be watching to see if these core inflation metrics moderate. The other thing we'll be watching is survey data on inflation. Are long-term inflation expectations remaining anchored or not? I think at this point they are, but we'll continue to watch that. The second area is going to be employment. We actually have the next employment report this coming Friday. We have 2 reports between now and their next decision. So far, the weakness in employment that we've seen has been really centered around areas that are most impacted by trade. We'll be watching, though, to see if there's any broadening of that employment weakness in the next couple of reports, as that's closely tied to overall growth. And the third thing would be growth itself. There's only 1 report. It does come in a little bit late. We do expect growth to slow in the second quarter compared to the first. Exactly how much is still to be determined, so we're watching that. And the final thing, again, let's end on a positive note. We have a new Canadian federal government. We'll be seeing if there's any early wins which could lead to positive economic developments in the Canadian economy.